This is Learning Objective 8 on disposing of notes receivable. As with accounts receivable, this doesn't mean we just get rid of them. What it does mean is that one way or another we remove them from the books. Okay, so with notes receivable, it's a little bit different from accounts receivable. If you remember, there we had credit card sales, or we could sell them to a factor. Here, when we take a note off the book, if it's honored, you say it's honored, that means that it was collected in full on its due date. And that's kind of the happy situation where somebody owed you money, they paid you, and you collected it on the due date. So everybody is kind of happy. And then there's the situation where it's dishonored, and that means simply that it was not collected on its due date in full. And where the note receivable is a legal instrument, once it's past its due date, it loses its validity. So it's no longer a legal instrument once it passes its due date. That's why it's said to be dishonored. So there's two different scenarios where when a note is dishonored. One is that, yeah, your lender can't pay you now. I mean, the borrower can't pay you now, but you know, they'll be able to pay you sometime in the future. And so that's a little bit disturbing, but you will collect the money sometime. And then there's this other scenario, which is the really sad scenario, where the borrower could not pay you on time, and you're never going to see that money. Okay? So obviously we've got a few journal entries to do here to describe what happens in these three different situations. Okay, so let's start with the note being honored. The basic journal entry, when we bring the note, I'm going to use an example of the, say a $1,000 note. I like 12% interest because that works out nicely with the math. It's going to be a 3-month note, and it's going to be issued, the issue date of the note is 11/1/2015. Okay, so the journal entry when the note is issued on 11/1/2015 would be your notes receivable. And then in this case, we're going to be lending out cash. It's not going to be in settlement of a receivable or sales. We'll keep it simple here. So here's our $1,000 and $1,000. At year end, you know that interest accrues over the life of the note, and we have to recognize the interest even though we have not collected it yet. So at 12/31/2015, 2 months into the note, okay, it's a 3-month note, we have to go interest receivable and we would recognize the interest revenue that we have earned so far. That would have to come on our books. How much have we earned so far? Well, it would be the $1,000 times the 12%, but then it's the $1,000 times the 12%, but then times times 2/12, because we've only had 2 months of the note. So that comes out to $20. Okay? And so we have booked at the end of the month. Then when we collect the note, since it's been honored, we collect it on 2/1/16. So it's a 3-month note. It's November, all of December, all of January, and then we collect it. So we know we're going to get cash. We know that the note receivable comes off the books for the full 1,000. We know we've got this interest receivable up here associated, and that will be collected. Of the 20. And then we have to recognize the interest that's been earned so far in 2016, and that will be the interest revenue. And that would be $10, it's 1 month. And we would receive a check for $1,030. Okay, so that's your basically what you need to know when a note is honored. The only other thing is, that I would just say, is if the note had been dated, instead of 11/1, if it had been dated, say, September 1, say instead of November, this was, we had 9/1, 2015, then we wouldn't be crossing accounting periods, and you'd simply do your note receivable and cash for the 1,000, and when the note was collected, it would be all of September, October, November, and then on 12/1 we would receive payment for that amount. We would get the cash of the 1,030, but and the note receivable would come off the books for the 1,000. But we would only be booking our interest revenue because there was no need for a receivable because it hadn't crossed an accounting period. Okay, so that is if your notes are honored. So now let's get to the less happy situation of what happens when your note is dishonored. And we'll start with the situation or the scenario where your note is dishonored. In other words, they can't pay it on the date it's due, but you expect that you can collect it sometime. Maybe they just haven't got the cash this week, but they can have it in a few weeks or maybe next month. And so we have to do a journal entry to describe what happens here. So if the note is dishonored, okay, and so it's dishonored, and this is sort of the scenario where it's not great, you're just a little bit, disturbed by it. You're going to see the money sometime. So what we do is we convert the note to an account receivable, but we convert the note plus all of the interest associated with that note into that accounts receivable. So when the note was dishonored on 2/1/16, I'm using the same example here, you would bring an account receivable on the books. And it would be for the full proceeds of the note, proceeds being the principal plus interest, so it would be 1,030. You would remove the note receivable from the books for the 1,000, and you would book interest revenue associated with that note. And this tells the story of what is going to happen, what's expected to happen. You didn't get the note now, so you have to take it off the books. It's no longer a valid instrument. So you convert the note to an account receivable, but you're going to include all the interest revenue associated with the note. So you have the account receivable for the 1,030, take the note off the book, book the interest. So that's the sort of that situation. Then we have the very sad situation where you have lent somebody money and you're never going to see that money. Okay? In this case, you simply are going to write it off. Okay? And the text ignores any interest that might have been accrued in the past, and I'm going to ignore that as well, and you don't have to worry about that at this point. So as with the accounts receivable, we simply would use an allowance account. We go allowance for doubtful accounts. And we would write off the note receivable. So it's just a matter of the journal entries telling the story of what happened. And here we just write off the 1,000. Okay? So you have your happy story about, you know, when you collect it when it's honored. You have the 2 stories about being dishonored. You're going to see the money sometime, or you're never going to see the money.